Retirement for Life. Your passport to a comfortable and confident retirement. The podcast that's equal parts education and entertainment, where we break down the retirement maze with a dash of fun and a heap of wisdom from your host, Christian Sear CPA, the passionate retirement specialist and president of Sear Financial Wealth Advisors, the independent registered investment advisor specializing in the AIM Retirement System.
Welcome back to another episode of Retirement for Life. Today, we're going to talk about what's on our mind, and it's a lot. I think a lot of clients are talking about what's going on in the stock market. People are curious. I've been on record in the last 17 years, the stock market has been up 15 of 7. Did you know that?
Oh, yeah.
15 in the last 17 years. That's an 88% win rate, which is like very unheard of. It has happened before, but you can honestly say it's a once-in-a-generation event. What's even more crazy, the last 3 years, 23, 24, 25, guess the number. What percent has the S&P total return been up? I'll save you the trouble. 85%. That is even more unprecedented.
Yes.
Okay. Yet I listened to my friend Tom Lee, who I think is fantastic, and he says 2026 is going to be up another 10%. Choppiness. He said we're going to see a 20% correction in this year, 2026, but don't worry, it's going to be fine. So let's talk about the market. What do you guys think about what's going on here?
Well, I think which way the economy goes will really play the biggest role in what the stock market does. And obviously, we're in a very uncertain time right now. There's been, tariffs. We're not sure where that's going to end up. I think a lot of companies are kind of in a wait and see type of mode. And that really comes out in the labor market. We've seen the unemployment rate kind of hover around where it's been
What's going on in the labor market?
So the unemployment rate's been around 4.4%.
Which is supposedly pretty good.
Yep, it's been that way for the last several months, hovering around that area. But what's weird is that, in the labor market, we see some underlying factors that are different than what you would expect just based on this steady unemployment rate. Like I said, we were kind of in a wait-and-see mode, so companies are doing a couple of things. Usually, you'd see this unemployment rate, steady hiring, steady firing, people quitting their job, but you're not really seeing changes to that. Companies have an all-time low hires rate, so the amount of people that they hire, it's at around like 3%, which is really low. And, if we were in a recession, that would be fairly normal, but right now, that's kind of unprecedented, and typically you'd see a much higher unemployment rate go along with that.
That's interesting.
So I think there's two reasons for that. One of them being people are just kind of staying at their jobs. The quit rate is extremely low. No one wants to take a chance, and hiring is very low.
Yeah.
That means you can't quit. Go ahead.
And the pool of people that being hired from, it seems like it's just so small.
Yeah, people are kind of just like staying in their current position for a long period of time. So that's why we're seeing the stagnant number. But, the underlying things at play are pretty important to look at. If we see layoffs pick up, I think that'll really send unemployment higher.
So the labor market's interesting to me. I saw something the other day that the payrolls are steady, like you said, and the jobs we see are being added to the 150, 200,000 jobs a month, but it's the type of jobs that are being added. It's the quality of the labor market.
Yes. So last year, just the, addition to jobs, outside of a recession, which, recessionary periods are they literally go off the charts in some ways, but outside of a recession, jobs added last year in 2025 were the lowest they've been since 2003, which I thought is really interesting. And really, when you look at the actual jobs being added, it's almost all healthcare and really nothing else. Everything else is flat. So that's a little concerning. But again, people aren't being fired or, leaving as quickly as they were either.
I think what's happening, and I hate to say this, but it's true, the separation of classes continues to have a greater divide amongst it. I saw the other day, back in the 80s, the average age of a first-time home buyer was 20-something. Today, for the first time, it's up to 40.
Jeez.
Okay? I can't remember the number. It was like 1/3 of children between the ages of 18 to 30. They're not children. They're obviously adults. But
Yeah.
1/3 of that age range, 18 to 35, are still living at home with mom and dad.
Mm-hmm.
And those jobs that are being added, you see a typical, think about people that in your circle of friends. A lot more younger people, instead of having like this wonderful, fantastic job, benefits, overtime, bonus, salary, all that great thing, they're kind of nickel and diming 2 or 3 kind of side gigs and parsing them together into what is enough to pay the bills.
I was just talking about that with a client. The gap has just continued to grow, and it's almost like the stock market and the real economy that we feel has had such a dislocation.
It's 2 different worlds.
In the last even 5 years now, you can say, and it doesn't feel like we've ever come back close again.
No, and
there's certain things that are just.
I feel really strongly about this. So the people that we work with, thankfully for them, have gotten over the hump.
Yeah.
Mm-hmm.
They've made their nest egg. They've worked hard. And now we're investing their money in a lot of diverse places. But just one example, Google.
Mm-hmm.
Google's earnings come out, and all these companies' earnings are coming out, and they're just making more money than they ever have.
Yeah.
But it's not because in some cases, they're firing people.
Yeah.
And they're investing in this technology and these things that are making more money, but our labor market is maybe not as strong underneath the surface.
Right.
Yeah, it's like the dispersion between lower income and higher income folks is getting wider. The wealth effect from the stock market has been big for a lot of our clients, being 60 plus. But then those post-grad college kids that try to find a job, it's becoming very hard. And I think part of that is probably AI playing a factor, but it's a very long-term thing that I think will continue to play out. So, I keep an eye on, like I said, what jobs are out there, hiring, firing, all of that, because any move in those pieces, I think, could make a huge difference in the overall economy and potentially lead us into a recession.
Hey there, RFL Show listeners. Did you know that 97% of Americans associate the word financial advisor with simply investing money? But sadly, there is one key piece of information most retirees do not realize until it's too late, and sometimes they miss it altogether. And although retirement is this great emotional victory, sadly, it's actually the beginning of the most treacherous part of your financial life. If you're considering working with a fiduciary who works exclusively with retirees and those nearing retirement, go to aimassessment.com. That is AIMassessment.com. Schedule a complimentary one-on-one visit with me. Ask questions about your retirement situation. Learn more about our trademarked AIM Retirement System and see if we may be a good fit for you. It all starts here with the conversation. AIMassessment.com. So we're guarding for this. Market's been up. Supposedly it's going to go up again this year. At some point, we're starting to see some softening in different areas, which is why I think a balanced portfolio is important. So if we're not investing in stocks, we also have to invest in some bonds too. And those are safe, aren't they, Ian? Supposedly?
Yeah, supposedly.
Right? Aren't bonds safe?
Yeah, I just read a Bank of America article about, why do we use bonds? Because they're supposed to be sort of a hedge against stocks. When the stock market goes up, you can rely on the bonds to sort of protect your portfolio. But, ever since 2022, we saw the opposite of that. In 2022, very unprecedented. Bonds and stocks both went down. And since then, we've seen the same thing, but in the other direction. The last 3 years, stocks and bonds have moved positively in the same direction. So there's a couple things, when we're talking about a diversified portfolio, bonds really aren't as good of a hedge as we thought they were.
By the way, before you get going on this, I have to say bonds broke my heart in 2022.
Yeah.
I mean, they just, when you think the world is right, when you think you know somebody, and bonds were like one of my best friends, and then they just tore my heart out.
I think it's lost a lot of confidence for people too. Their 401ks talk about, the stock market boom here, but in 22 they got a big scare. Most people with a big big lump in their 401k as their nest egg.
Yeah.
When everything went down, it wasn't, even if they had some sort of balanced portfolio, you had to be very careful in those times.
So in 2008, stock market goes down 38%. Bonds were up, right?
Mm-hmm.
Yep, exactly.
But the average bond portfolio in 2022, when the stock market was down, I think it was down like some 15%. So has the correlation changed? Is it gone?
Well,
or is
so
it there,
when
or
we're
what?
yeah, so what the article was about is it's basically saying let's talk about it like a typical retirement portfolio, maybe 60-40. A moderate person invested 60% equities, 40% bonds. Well, just thinking about it intuitively, when the stock market has risen as much as it has, what do we do on our end? We rebalance those portfolios and we maybe take that equity that's grown to 70% and knock it back down.
in bonds.
AKA, selling stocks and buying bonds. So I think it was somewhere around, like 40,000 of money in $1 million portfolio was shifted from stocks to bonds every single year for the last 3 years. And so what that did is really ramp up the demand for bonds. Obviously, selling stocks, it didn't affect the stock market. It continued to go up, but that demand for bonds over the last 3 years accounted for over 20% of the new issue bonds.
Wow.
Which is a lot higher than it has been historically.
Wow.
So, what that did is it made that positive correlation between stocks and bonds. The higher demand made, bonds look really good. So I think if we're talking about a world in the future where maybe the stock market moderates a bit and we see a little bit slower growth, maybe that demand for bonds tapers off a bit and we see bonds become a better hedge, in the future for
I
stocks.
hope so. Or we have to find a different hedge. Yeah. Any ideas for a different hedge? What are we going to do? If bonds aren't the hedge to stocks anymore, I don't know.
I mean, fixed index annuities play a part sometimes.
I love that answer. That's exactly right.
Yeah, fixed annuity rates.
I love that.
Look now, very.
We were just talking in the last podcast about what you can do with your taxes.
Mm-hmm.
The other thing too is right now, if the market has gone up 85% in the last 3 years, if you are 65 on the eve of your retirement, here's an idea that probably is not going to be a bad idea, and I wouldn't suggest this.
Mm-hmm.
But if you put your entire portfolio into what Ian just said, you're probably going to get about 5%. Like, what's the best, just flat up, not index annuity? What are you getting in annuities these days? Like a MIGA.
Over 5.
Yeah, probably like
over
5.5 or
you
6.
Could just, and I'm not saying to do this, but one idea that's not going to kill you if you've saved money and you have done a good job saving and you are on the eve of retirement is just park it in a guaranteed 5% account. Yeah. That's a good alternative. And you can rely on that too. Mm-hmm. Very interesting. Huh. Okay. So now that we have that settled, do we just drop everything and get out of the stock market, or we just continue on and have a balanced, diversified portfolio?
Yeah, I think keeping some protection in the portfolio is important. It's, you could have said 2 years ago, wow, the stock market is at an all-time high.
I did say that.
Jump out?
I did say that 2 years ago. You
that,
talked me out of it.
Yeah, you could say that every year. I think it's still important to maintain some safety, but also keep a diversified portfolio.
Yeah, definitely. Think about 22, what we just talked about. If we would have put all our eggs in one basket, everyone thought bonds were going to go up if the market faltered, and I mean, every expert said so, and look what happened. So you have to keep it diversified.
Yeah.
Just so you save any unexpected event.
Aren't you glad we don't do tactical investing anymore, Ian?
Yes, yes.
You used to talk me out of the ledge often. Now Emma talks me off the ledge. And yeah.
Yeah. Speaking of that, we all want to know when the market's going to go down. So I was just looking at the market and just a broad picture of the market over the course of 2024, and then a broad picture of the market over 2025. And it's amazing how correlated they are.
Really?
The peaks and troughs. It's really amazing. And I mean, we're not trying to time the market or anything, but it would be interesting to see if some of those turning points are similar turning points to this year.
Yeah, because both of those years, if I recall correctly, there was a dip like in the first quarter of both those years.
Yeah, and we blamed it on tariffs in 2025, but in 2024 we had a dip as well. So it could be more related to data than we want to admit.
Now, Emma, you used to trade bonds.
Mm-hmm.
Not trade bonds, buy bonds, would you say?
Yeah, follow bonds. Yeah. I wasn't the actual trader, but yeah, I followed a lot of.
So do you miss
Yes.
that? Like your Miss Bond.
It's definitely different. Yeah, like following companies and being very in detailed into their financials is definitely a different day to day than I have now. But I don't necessarily miss it.
I mean, I'm not sure what you love to do, but like, do I want to buy bonds all day for an insurance company, or do I want to walk and talk with like really dynamic 60-year-olds who have been pilots, who have been rocket scientists, who have
Yeah.
Nobody said bonds were the most exciting thing.
It sure is.
Okay, but it's good to have somebody on the team that knows so much about bonds.
Yeah,
as
but
you do.
sometimes the least exciting thing is the most important. I mean, look at Roth conversions. That's not exciting to most people, but it's important, very important.
All right, so I'm going to go around. I'm going to go first. One sentence summary on what we just said here. I'm going to say stock market seems to be still okay. More risk going forward, perhaps. Watch the underlying softening of things like the labor market.
Mm-hmm.
What would you say? How would you summarize this wonderful podcast?
Keep a diversified portfolio for some unexpected terrain this year.
And don't look into an annuity.
Yeah, there you go. If you're really scared about it, there's more than just
We
stocks,
mix and
bonds.
match, right?
Yeah.
We together. What would you say, Emma? What would you summarize what we
I'm
just said?
keeping an eye on like the structural changes in investing and how our clients' portfolios are performing, and then also a close eye on really all of the economic indicators that we have. That's all we can rely on, because I do think any one small thing, negative change could affect our portfolios.
Yeah.
It's going to be some interesting conversations towards the ends of 2026 as we go forward and look at some of these metrics and what we do to analyze our portfolios. That's it for Retirement for Life podcast. Brooke, what number do you think this was? I don't even know. It's in the 40s.
Yeah, it might be 51 actually.
It's in the 50s.
Yeah.
Oh my gosh.
It's an
I mean,
honor.
that's a milestone.
Yeah.
Ian, you're a great addition to that. And we're going to have to bring Andrea back too, because people,
Yeah.
I can just see the text.
Yeah,
in
where's
the
Andrea?
Where's Andrea?
Busy today.
They could
She'll
care
be
less
back.
about me. Where's she?
And I think what we're going to do is I'd love to have a new environment here. So, Brooke, can we work on that?
Yep.
Let's get some couches in here.
Yeah, I was promised a couch, Brooke.
On it.
All right. We'll see you guys on the next Retirement for Life podcast. Thanks for tuning in today. Take care.
Investment advisory services provided by Sear Financial, Inc., SEC registered investment advisor. All content on this podcast is for information purposes only and should not be considered investment, legal, or tax advice. Material presented is believed to be from reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness.